By now, hopefully you are seeing the recordings as they're being posted up under the various chapters. And I think you'll see, for example, a chapter 2, part 1. We're going to finish chapter 2 tonight, so that'll be part 2. I think we'll either finish or hopefully even start chapter 3 tonight. And so when that happens, just so I don't have to try to cut the file, because if you try to edit it, it takes forever. So what I'll do is at the hour minute mark that we start chapter 3, I'll indicate that in the posting, in the description of the posting. I'll say chapter 3 will start, and I'll give you I think they take it down to the minute, the hour, minute, and second as to when it starts, and I'll mark that appropriately so you'll be able to see that. Okay. So what I want to do tonight is finish chapter 2, and we're going to do a quick drill on debits and credits. And then what I want to do, even though we started it last time, is go through the year 1, year 2 example for chapter 2. We'll start again with year 1. I think it's more meaningful to you to review that again. And then if you can kind of see how year 1 information rolls into year 2 all in one sitting, I think that's better. And then once we do that, we'll be able to look at the quiz, not quiz, I keep calling them quizzes, the practice midterm for chapter 2. And then, like I said, time permitting, we'll actually start to make some forays into chapter 3. Okay. So before we go much further, I want to go ahead and put up the discussion of debits and credits. Okay. And of course, I have to put the wrong slide deck. Okay. Try that again. Okay. So let's just take a look again to make sure we're comfortable and with the basic debit and credit discussion. Okay. And what debits must equal credits. And it was key that we understood from this slide how our debits and credits would affect these various accounts that are listed here, right? So I'm going to take these little arrows away and let's just sort of go through it together, and you can go ahead and unmute if you want to kind of chime in vocally, okay? So to increase an asset, we debit or credit?
Debit.
Debit, good. To decrease the asset, you credit it, right? To increase a liability, you
Credit.
credit, good. To decrease it, you debit it. To increase our equity is right now it's common stock and retained earnings, right? To increase equity, we credit, good. To decrease it, we debit it. Excellent, guys, good work. To increase revenue, we
Credit.
credit. To decrease debit. To increase expenses, we
Debit.
Debit.
to decrease credit. Good, nice. Good job, guys, okay? That's sort of how you need to get with this stuff. You need to get almost like a reflex on this. And again, I don't mean to put this harsh of a message up here. I mean, I guess I do mean to do it. It's there and I could delete it if I didn't really want it to be there. But I just want to emphasize, I know you'll pass this class. I know you're going to get an A in this class, so don't take it that way. But I do need you to really, really know this stuff. You need to be sleeping with this, but it sounds like you are. Okay, sleep with this under your pillow. All right. Okay, good. Any question on that? Okay, good. It is not enough to know how to increase and decrease these various accounts. You also have to know which accounts are assets, which are liabilities, which are stockholders' equity. Revenues and expenses are pretty easy because they generally have the word revenue. They have the word expense on them, so that's not too difficult to remember that. Again, the reds on this slide mean nothing, okay? Just wherever I borrowed this from, it so happened to have some red, but that's okay, okay? Assets have what? Future economic benefit, right? So cash is an asset, your favorite. Account receivable is your second favorite asset because it's going to be cash pretty soon. Supplies, right? Equipment all have future economic benefit. Okay, prepaid. Sometimes students have trouble and say, I don't see why a prepaid is an asset. And I'm like, well, that's almost the easiest one to remember, because if you prepay something, that means you're going to do what? You prepay your BART ticket, whatever, you're going to be able to use that for prepay. You can use this for the next 6 months or something, right? So you've got obvious future economic benefit, right? Our liabilities are our bills, right? So we have what? Note pay a bill, account pay a bill, wages pay a bill. And I'm saying it annoyingly like that on purpose so that we get the sense of, oh yeah, pay a bill, my liabilities, right? Interest pay a bill. Okay. Now, unearned service revenue, we remember we said last time, is a little different liability, and that usually, you don't want to owe money. Liabilities, we tend to think of them bad, but unearned service revenue means someone gave me money. They thought I was so talented. They gave me money and said, hey, I want to book you for the next year or something, right? And so when analysts look at financial statements, they look at that unearned service revenue as a good thing, because if they can see what that unearned service revenue number going up steadily year over year, they start to think, okay, this person's in demand. They've got business booked into the future on a consistent basis, and they might be more willing to extend us credit or something like that, right? Okay. You look at the stockholders' equity right now. Our two stockholders' equity accounts are common stock and retained earnings. And then we put dividends and income summary under stockholders' equity. And it's really what, if you think about it, it's under retained earnings, because remember, our piggy bank is what? Beginning balance of retained earnings plus our net income minus the dividends gives us the ending balance. Year one's ending balance becomes year two's beginning balance, and so on. So retained earnings is really the history throughout the entire company of what our net incomes have been year over year minus any dividends year over year. So that's why we put those two accounts there under stockholders' equity. Revenues, like I said, they generally have the word revenue associated with them. You provide a service. Somebody either gives you cash or agrees to pay you later because you provided that service. You can take the revenue, right? Now, remember, we said that the important thing here, and we'll review this here again when we go the year one, year two example, you don't have to actually receive the cash to have earned the revenue. If someone agrees to pay me later, as long as I provide the service, I can still take the revenue, right? And I think that was the example when we looked at that. Remember that one that was like an Excel spreadsheet, and it was SoftBite company, Ray and Barbara Neal, right, had that company, and they had the situation where they provided the service. They didn't get the cash up front. They billed the customer would pay them later, but they could take the revenue because they had provided the service. Had nothing to do with when they collected the cash. Expenses, same kind of thing, right? And that we don't have to actually pay the cash to recognize the expense. As long as there's no more future economic benefit associated with an activity, that future economic benefit has expired. We have incurred the expense. We go ahead and we take the expense, even though we may not pay that until some later time, maybe in the next year or something. Okay. Any question on any of these? Okay. And then we had this one, which I thought was kind of a little, kind of a cool slide, because it shows you how to increase and decrease each one of these using your debits and credits. And then it puts them into their categories of assets, liabilities, and then our stockholders' equity, common stock, retained earnings. And then, of course, our retained earnings is affected by our revenue minus expenses. Revenue minus expenses are going to be my net income. Let me just write it down here. I've got something in my way here. Let me see if I get that out of the way. I might feel more comfortable where I'm writing. Okay. Okay. So I've got what? Revenue minus expenses equals what? What's NI? Net income. Net income does what? Increases my retained earnings, and then my dividend does what? Comes out of my retained earnings, right? And that was how we came up with our retained earnings balance. Okay. Okay, good. Now, when we looked at our year 1, year 2 class example. We analyze the transaction. First, we enter the transaction into a journal. First, F-I-R-S-T, John. First, we enter the transaction. Don't try to talk and write at the same time, apparently. First, we enter the transaction into the journal, and then we do what? Then we post to the ledger accounts, okay? And that was really what we were doing in that exercise that we were talking through. And that whole process of going from the journal and then posting to the ledger is a very mechanical process. I'm not going to make you do much of that. I'm not going to make you do any of that in any exam situation. We're going to do it here together, looking at this in-class example for chapter 2, year 1, year 2. But then, you know, by the time we are getting to our practice midterm, our exams, I'm not going to hold you accountable to knowing how to mechanically keep track of these transactions. I'll expect you to know how different debits and credits affect the accounts, but I'm not here to see how, you know, good you are at doing a mechanical process, because I'm going to show you some general ledger software towards the end of class today, so you see how this would all be done in an automated fashion. Okay, but we're going to go through this example together. And guys, I'm just going to apologize up front when this thing starts giving me a hard time. Please don't hate me too much, okay? Because I apparently have no ability to figure anything out when it's not working. As long as everything works, I'm a genius. Things stop working, I'm in trouble, okay? I've got a problem right now that when I'm in Windows File Explorer, I can't open any file from Explorer. I can open the same file if I'm in the software itself and try to open it from the software. But if I'm just looking at my Explorer and I'm looking at how I have my files organized, say on my desktop, I can't open them from there. And I don't know why that's happened, but anyway, so that's been the bane of my existence today, trying to figure that out. But anyway, it's like, okay, John, keep your personal problems to yourself, right? Okay, so let's just go ahead and let's take a look. And we have what? We have our journal. We start our company, brand new company. And I know we went over this last time, guys. I'm repeating what we did last time. And I issue common stock for $1 million cash. So what happens? Investor hands me $1 million. I hand them the stock. So I now need to show that I have some stock outstanding. I, as a corporation, have issued some stock to my investors. So I need to show that I have people out there that have an ownership stake in this company. We call them common shareholders, at least at this point. And so I have increased my cash. I want to increase cash. I debit cash for $1 million. I want to increase my common stock. That's a stockholders equity account. I credit it. Now, how do I know from this presentation that I have debited and credited my cash? Debit on the left, credit on the right. You can see how that credit to common stock is slightly indented. Debit on the left, credit on the right. Okay, so I enter transactions in my journal. And then I do that first, and then I will do what? Post to the ledger. Okay, now when I post to, that says post to the ledger, it's a mechanical process, guys. It's mechanics. It has nothing to do with any sort of, you know, complicated theory. It is simply a mechanical thing that they've been doing since the 12th century. So they do what? They take something and they carry it over to the to the ledger and plow. They pop it in there as a debit, and when we do, what happens? The scale goes up on the debit side. There's now $1 million sitting in my cash account. Okay, I did that with the cash. Now I do it with the common stock. I take that common stock credit for $1 million. Get this mouse out of the way so I don't keep trying to. I got 2 mice here and I only need 1. Okay, so what happens? I go ahead, I take that $1 million and I do what? I just pop it over here. Bang, $1 million. Now I sit here and I have $1 million in my common stock account, right? Okay, now I would be able to, the whole reason we do this, we don't do this because, San Jose State said I have to study accounting and so I have to do this. We are doing this as business entities so that I can prepare financial statements. If you took away the idea that I have to prepare a balance sheet and income statement in order to attract investors, we could throw this whole thing away. Okay, but they tell us we have to prepare these statements. This is the system. Okay, so I go ahead and I look, and don't write this down, guys. Do I have any assets? At this point, I have what? Cash of $1 million. My liabilities at this point, presumably theoretically here, I've only made this one transaction. I've only had this one transaction. So my liabilities are what? Zero. My stockholders equity, and presumably at this point, I've only done the one transaction. I have what? Common stock. My common stock is $1 million. Does my balance sheet balance? Balance sheet balances. Why? Because I made sure that what? My debits equal my credits. As long as you keep your debits and credits in balance like that, you keep them in balance when you post them over here, you'll be able to prepare a balance sheet that balances. Okay. All right. Now I'm not going to keep doing that this time because last time we kind of went along and then at the end we filled this whole thing in. And I forget who asked me the question, hey, how am I supposed to, know what you wrote here later on if I want to look back at it? And I said, well, you could go to the recording and find the spot where I finally wrote everything in. And you could do that. But the other thing that I decided to do after we got that question was go ahead and you'll see under chapter 2, you're going to see markup. Okay. And if you open markup, you're going to see where I write in the financial statement, the balance sheet, the income statement, the statement of retained earnings, the balance sheet, and I write those in, although it's a bit sloppy. But if you look at the video, you can kind of see what we're doing at those different parts. But that is there also all written in. I'm not going to open that. Well, yeah, okay. Let's see how much trouble I get myself into if I try to open it now. Okay, see how I wrote them in there? So I'm going to do that again when we get to the end, but there's also a file up there that has them all kind of scribbled in there. Okay, all right, good. So I can get rid of that. I don't need to look at that. Okay, okay, good. Now we come over and you take a look and we purchase a building for $1.2 million and we take a $200,000 mortgage on that. So what happens? In our little business, I think we said we were a DJ business. We're DJ Pizzazz, whatever, right? And our business does what? Sometimes we will host the party at our place and we'll DJ because maybe the person trying to throw the party needs a facility as well. So we can do that. Other times we're going to come from our facility and we'll go and we will actually put the DJ the party at their location, right? Whoever the party thrower is, okay? So we say, well, we need a building when we're going to be the one that hosts the party. So we find a perfect DJ-shaped building and we say, this is the spot for us. It's right near town where other people can come and visit, blah, blah. This is the one we want. So we walk in and we say, this is the building for us. And the guy says, good, give me 1.2 million. We say, oh, come on, we only have $1 million. That's all our investors would give us. The guy says, hey, get out of my way. I got somebody else ready to buy it if you don't want it. I say, okay. I'll tell you what, I'll give you $1 million cash up front and let me pay a bill to you. Give me a mortgage, pay a bill. I'll pay that over the next, and could be a couple years, could be 30 years. The word mortgage, mort, means death. Okay, so it's generally a longer, let's hope, a longer term liability is a mortgage pay up bill. Okay, so the guy agrees. He says, hell yeah, you're going to give me $1 million up front? Really? Okay, I get $1 million now, and then what? And then you're going to pay me the rest? Yeah. Now what happens? I get all the risks and rewards of the building. If I mess up and do something stupid and the building collapses, I'm the one that suffers the loss, okay, not the person that that is selling me this. So I take full possession of the future economic benefits of that building. So I go ahead and since my asset building is increasing because it has future economic benefit, right? A building is an asset. I'm going to go ahead and I'm going to debit my building to increase that. I'm going to credit cash because what happens? Cash is the easiest one to get used to, guys. If your cash is going down, if you're paying cash, you're giving cash away, aren't you, when you pay cash? Okay, so when you hand that cash to somebody else, your account balance has to go down. How do you decrease an asset like cash? You credit it, debit to the left, credit to the right, and now I still owe the guy. I have a bill, a mortgage pay up bill of 200,000. How do you increase the liability? You credit it. My debits equal my credits. I post those. I post building. Building shows now what? 1.2 million. And what happens? I come over. I credit my liability now, mortgage pay up bill, 200,000, and the balance sheet will still balance, right? Question? Okay, good. Then I go ahead and because we're going to sometimes be the ones that go to the party place where they want the party to be thrown, we're going to show up there. We're remote DJs sometimes. So what happens? We go and we need a vehicle. Now we don't have any more cash left, but we walk into the auto dealer or whatever, and we see one of those fancy black limo type van things. And we're like, that's perfect for DJ Pizzazz. That's what we're going to show up in, right? We're going to look good. So what do? We say, yeah, we want that thing, but we tell the vehicle dealer, we don't have any money. Vehicle dealer says, no problem, no problem. They check our credit. They see we have good credit. We're going to drive that vehicle off with no money. Okay. And sometimes students say, no, you can't do that. Do you think LeBron James got to give the guy cash when he walks in to buy a vehicle? And no problem, Mr. James. Take the whole showroom. Go ahead. No problem, because they know he's got good credit. He's good for it, right? You'll be in that position as well. I'm telling you right now, someday you will buy a vehicle for no money. You'll drive off and you wouldn't have given them a dime. Okay. So what happens? You will go ahead and debit vehicle because you've taken all the risks and rewards of ownership. If you pull the vehicle out and you turn too sharp and you scratch the pole when you're going out of there or whatever, they're going to say, the vehicle dealer is going to say, look what happened to your car. Okay, it's your car at that point when you drive it off. So you take all the risks and rewards of ownership. So yeah, we're going to debit the asset vehicle and we will credit the pay up bill 150,000 because yeah, even though the guy checked my credit and he's trusting me to drive off with that vehicle, try it sometime. Try driving a vehicle away and then tell the guy, here, I'm not going to pay you. See what happens. Okay. So what happens? We're going to have a liability now. We have to pay that 150. So what happens? We debit equipment, 150. Our equipment balance goes up 150. And then we credit vehicle pay up bill 150,000 and our balance sheet will still balance. Okay. Okay, good. Any questions so far? So now we get hired to do one of those DJings at the concert where we go remotely, right? And so we get all our stuff over there. We do the DJing. The guy says, hey, man, thanks. Everybody thought the party was great. So he reaches in his pocket and he pulls out $200,000 cash. Here you go. Here's the payment we agreed upon, right? So what happens? Well, if that's the case, we'll debit cash 200,000. Okay, our cash balance then, of course, will go back up to this 200,000. That's good. I didn't like having zero cash there for a while, right? But now it's come back up. I credit revenue. To increase revenue, you credit it, debit on the left, credit on the right. Anytime that you provide a service in the area of business that you've chosen, okay, we've chosen DJing and we just made some money for that. We call that revenue. And so we go ahead and we credit revenue. And when we credit revenue, our revenue increases to 200,000. Okay. Now what happened? we had to get all our equipment and everything to the party, and we had to get it back and stored away back at our place. So we hired some of these Lyft guys, and these guys are pretty, pretty big people, right? And they say, okay, we're done. We'd like to be paid now, and I'm like, oh, okay, these guys are kind of scary, but all right, we'll pay you. How much do you want? 70,000. So what do? We reach into our pocket and we hand them $70,000. Now, when we do that, we go ahead and we credit the cash, obviously, because what? I had 200,000 in my pocket. I'm now handing them out 70. So my cash comes down 70. Yeah, I got 130 left in my pocket, right? Doesn't the system work? Isn't this beautiful? Okay. Now what happens? There's no more future economic benefit expected out of those guys. Okay, they're driving away, and I was like, see you later. I'm thinking, I don't know, I'm gonna use these guys again. I don't know, they seem a little rough around the edges, whatever. They're gone. There's no more future economic benefit expected from that 70,000. So since the future economic benefit has expired, and I'm saying it weird like that on purpose, we will do what? We will debit expense. Okay, so we go ahead, we debit expense. To increase expense, you debit it, right? And so when I debit that expense, now my expense is showing 70,000. Okay. All right, good. Now, what happens? I'm DJ Pizzazz. When you see me at the DJ party, I'm the coolest dude in the world, right? When you see me on the street, I'm Irving. I'm just a very humble guy. I can't even look people in the eye when I'm on the street. I have a total different personality, right? I'm Irving on the street. So what happens? Irving wants a sandwich. Irving wants to get his, clothes cleaned. Irving wants to, go and watch a movie or something, right? So Irving, the human being, needs to take some money out of the corporate DJ Pizzazz Incorporated accounts and use them for Irving's personal use. And so what happens? When we do that, we call that pulling the money out of the piggy bank's butt. We call that what? A dividend. Okay, we're dividing the earnings out. Now, in this case, maybe there's only one shareholder, right? But if you had several shareholders, you'd be paying a dividend by dividing your earnings out to various individuals. That's why they call it a dividend, okay? And so when we do that, we debit this account dividend. To increase dividend, you debit it. When I increase dividend, I debit it. I debited 13. So now I'm showing that this year I paid a $13,000 dividend out to Irving, right? And of course, since that money's coming out of the corporate accounts and into Irving's personal account, or he's spending that money on hamburgers or whatever, I do what? I credit my cash. And when I credit my cash, the balance comes down to 117. Question on any of that? Okay, good. Now I can prepare
I
my,
have a question.
yeah,
Can you hear me? I'm sorry.
I can hear you, yeah.
Okay. Two questions. For taking the party example, if we get deposit, say that they want to book our time and they put down like a $5,000 deposit, does that go into cash or does that go into revenue? And second question is if we get tips, that's basically extra cash that they gave it to us because we did a good job. And is that also recognized as cash or revenue?
Okay, every transaction affects two accounts. Okay, so when you say, is it cash or revenue? My answer is yes, because every transaction affects every account because every transaction has a debit and a credit, right? And it would be somewhat nonsensical to debit and credit the same account because that does nothing. Okay, so every transaction affects two accounts. If they give me a tip, that is additional revenue, right? And so I would debit cash, I would credit revenue. Hello?
Sorry, I had my mute on. Okay, so basically debit cash, credit revenue for tips.
Yeah, I'm just curious, why do you think a tip would be any different? They handed me cash, right, for the agreed upon price. I was so good, they gave me a tip, so they handed me more cash. So I would debit cash to increase it, right?
Okay. I wasn't sure because I wasn't sure if that counted as an income or just as cash.
Well, again, every transaction affects two accounts, right?
Right.
Okay. And because they're paying DJ Pizzazz a tip, why would it not be included in the accounts of DJ Pizzazz Incorporated?
Okay. Got it.
Okay, so DJ Pizzazz got a debit cash, right? And he got extra money for doing what he does, DJing. So I had to credit revenue. Okay?
Right. So the same goes with deposit, basically.
What is deposit?
Meaning it's a cash that we receive before we start the gig.
Well, no. I mean, I don't think anyone's going to pay me a tip before I do the gig, are they? Or you want me to
No.
answer the deposit question now, huh?
Okay,
Megan,
no, because I just had like two types of income that we come in, and then one was tip and one was deposit. So I
Okay,
was
right.
just a little bit mixed
Okay.
up
On
on
the
which category.
deposit question, hold that, okay?
Okay,
We're going to see what's going to happen. We're going to have an example of a transaction like that in year two.
okay, I will wait.
Okay. Okay, good.
Thank you.
Uh-huh. Okay. And guys, when I ask you those questions, I apologize for the way it comes across. Auditor for 26 years, I have a certain tone when I'm trying to get to a point. I don't mean it the way it does. I don't mean it to sound as prosecutorial as it sounds. Okay, so forgive me for that. Okay, so now I'm going to prepare my financial statements. Okay, and when I prepare my financial statements, I'm going to prepare them in order. What's the first financial statement I'll prepare?
balance sheet.
The income statement.
Good. First, good. First, I'll prepare the income statement. Okay, beautiful. Okay, and so when I prepare the income statement, why do they call it the income statement?
It shows the net income.
Good, it shows net income. And so how do I calculate net income?
Revenue minus expenses.
Good, so on the income statement, I have to show my revenues minus my expenses so I can show my net income. Good. So I'm going to go ahead and I'm going to show revenue. Revenue is, do I have any revenue? And guys, preparing the financial statements is the easiest part. You simply look to see what's in the ledger accounts that match the name of the thing you're trying to put on the financial statement, the line item you're trying to put on the financial statement. So I'm trying to put revenue. I look to the revenue account. Okay, thank you. I have 200,000. I put 200,000. Expenses, do I have any?
Yeah.
How much?
The building and the car.
No.
No.
No, it says expenses. I'm looking for accounts called expenses. Expense is what? Expired.
70,000.
Future economic benefit has expired, hasn't it?
Oh, okay, that's right.
Has the future economic benefit expired? And I'm saying it like that on purpose so we know that's expense. Has the future economic benefit expired for the building? Unless there was a really bad earthquake, you know, that night, or unless I really had a party and I drove the car into the building, there shouldn't be any more future, there should still be some future economic benefit left, right? So my expenses are what? That was the money I paid to those Lyft guys. They drove away. I'm like, bye, I'm not using them again. They're gone. I don't want to see them anymore. They scared me. Okay, so what happens? I have expenses of what? 70,000. Revenue minus expenses equals there's my net income. What's reported on the income statement?
Net
Okay.
income. Net income.
Net income. How do I calculate net income? Revenue.
minus expenses.
Good. Okay. Okay, good. There's our income statement. What statement do you want to prepare next?
Retained earnings.
Then of retained earning.
Good. Now we want my statement. It's a statement of RE is retained earnings, guys. Okay. Statement of retained earnings is the second statement I prepare. So I'm going to prepare my statement of retained earnings, which is my whatever. That's a pig, not a very good one. I'm going to prepare my piggy bank, right? Okay. And so when I prepare the statement of retained earnings, I have beginning balance. And since I just started business, what's my beginning balance?
0.
Good.
No.
0. I haven't done anything before now, right? Good. Then I put into my piggy bank goes my net income, right? So I go ahead and I add, I'm going to put an A there. I add my net income, and my net income was how much?
130,000.
130,000. See how it comes down from the income statement? Okay. Just bring it down, just pull it down there. And then I have to subtract my dividend. That's an S for subtract. My dividend, did I pay any dividends?
Yes.
Okay, dividends? Yeah. Preparing the financial statement is the easiest thing, guys. Just look at the account that you're trying to put on the financial statement and see what the balance is. Now, I couldn't do that for net income. I had to pull that down. But for my what? For my dividend, yeah, it was 13,000, right? Good. And what's my ending balance?
117,000.
Ending balance, good. Just doing the math on that, right? Is 117,000. Good. So you can always figure out what's the ending balance is by saying, hey, that's those circles. Beginning balance, add net income, subtract the dividend gives me ending balance. BASE, base. Beginning balance, add the net income, subtract the dividend equals the ending balance, 117,000. Question? Okay, good. And then my third statement, the last one I'm going to prepare here, is going to be what?
The balance sheet.
Good. Now I can do my balance sheet. Okay, so let's try that. So balance sheet, why do they call it the balance sheet?
Liabilities have to equal assets.
Because it needs to balance.
Balances?
Assets equal
Yeah.
liabilities, stockholders equity.
Right. It balances. They call it the balance sheet because it balances. What balances? Assets equal liabilities plus stockholders equity, right? So what appears on the balance sheet? Assets, liabilities, and stockholders equity, right? Okay. Okay, good. So we come over and I ask you, do we have any assets? Assets have future economic benefit. I look up here. Here's my assets. Is cash an asset?
Yes.
Your favorite, right? Okay. So I go ahead. I don't know about you, but my favorite asset is cash. I mean, I say that, but then I spend my cash to get other assets that I like too. So, but anyway, stop, John. So cash, right? Because I can turn that into any future economic benefit I like, right? Okay, within the confines of the law. So that's what cash 117. Any other assets?
Equipment and building.
Good. We got the equipment. Good. We got the building, or both assets. Both have future economic benefit, right? And so I'll go ahead and I'll put the equipment. What was it? 150,000 for that fancy van. And the building was what? 1,200,000. Okay. Okay, good. So what happens? Any other assets? Looks like that's it, right? No more assets. So my total assets are, somebody can help me out with the math here, 1,467,000. Do I have a
Yes.
confirmation on that?
Yes.
Okay. In this class, if you call out a number and I ask for a confirmation on it, never take it seriously. In accounting, every number that we put down gets verified. The agency that I used to work for, the Government Accountability Office, every number, fact, figure, statement of fact in our report is checked by a second person. Okay, it's the worst thing in the world to be assigned. Okay, so what happens? I say to you, hey, will you reference for me? And you say, what? You got some incriminating evidence on me? Why are you asking me to do this? What do I owe you this horrible task of having to look up in the work papers every single thing that you put down in your stupid report? This is the nature of this business, is we make sure that everything we put down, we have a second set of eyes on it. Okay. Okay. So total assets, we've got that confirmed, 1,467,000. Okay. Then we sit here and we look at our liabilities. Okay. And so when we look at our liabilities, our bills, do we have any?
Mortgage and vehicle.
That guy still wants the 200,000 and the guy still wants his 150 for the vehicle, right? We haven't paid any of it yet. Okay, so we still have those bills. We have the mortgage payable. $200,000. And we've got what? The vehicle payable. What was that? 150,000. Okay. Okay, good. Any more liabilities? No, I don't think so. Just those two, right? Okay. Okay, good. So we go ahead and we can total up the liabilities. And I can do that one in my head. That's 350,000, right? Me and my ridiculously too exaggerated commas. That's 350,000. Okay, good. So my balance sheet doesn't balance because I haven't shown what yet? Stockholders equity. Stockholders equity. Okay. So do I have any stockholders equity? I've got what? Common
$1 million.
stock. And right now, my retained earnings is still showing that beginning balance of 0 because I haven't done any entry. I haven't debited or credited anything into retained earnings. Nothing gets into these accounts, guys, unless I do a debit and credit in the journal first. And at this point, I haven't made a debit nor a credit to retained earnings. Okay, so I can't get anything in my ledger until I put something into the journal. First, we put something in the journal, then we post it to the ledger. And so far, I haven't entered anything in the journal for my retained earnings, but that's all right. That won't stop me from preparing the balance sheet at this point, because all I have to do is put in my common stock, which was what, $1 million? And I can pull my ending balance and retained earnings down from the statement of retained earnings. I know what the ending balance is because I just calculated it up there. So I can go ahead and report retained earnings, RE, of what, 117? So my total, my common stock and my retained earnings, my total stockholders equity, I add up to be 1,117,000. And then my total liabilities plus stockholders equity, I'm going to add up these two numbers, is 1,467,000, I hope. That doesn't add up. That's when accountants, that's when things add up. If things always added up perfectly, I'd still have hair. Does this add up though, please, guide?
Yeah.
Okay, good. So my balance sheet balances, doesn't it? I didn't make any mistakes. I did a good job. I was able to prepare my balance sheet just by doing what? Picking up the amounts in the ledger accounts and writing them up in the form of financial statements. And yeah, I had to pull the ending balance of retained earnings down to my balance sheet. And when I did that, it worked, right? Question. Okay, good. Now, I have,
Sorry to interrupt you.
yeah,
I have one question. So let's say I want to put this in the real life example. I go to my CFO and I ask him, hey, listen, how much cash do we have? Would I look at this balance sheet? Is this like the real time snapshot of how much cash the company has right now?
Financial statements are historical documents, okay?
Mhm.
So unless you're able to do this, you know, the clock strikes 12 on December 31st, going into January 1st. And if you're able to finish all this before anybody has time to get up and go to draw any money out of the bank, my answer would be yes.
I see.
Okay. So this is a snapshot at December 31st. Okay.
Okay.
So the way to think of the balance sheet is your wallet. This is what you had in your wallet December 31st. And if you hurry up and make the financial statements before you go to breakfast on January 1st, then these two will match.
Mm-hmm.
Okay. I went through a period there where I was losing my mind, because what I would do is I had a software that I was using, and I called it my electronic wallet. And I would actually use debits and credits every time I put money in my wallet or took it out. And then I would entertain myself by counting the money in my wallet and seeing that it matched the amount that was in the electronic wallet. And I would do that, you know, a couple, 3 times a day. And then one day I was sitting by myself with no friends, and I realized I should stop doing that. Okay. But yeah, you know, if you really want to, you know, do that. Now, in on a more serious note, looking at it from the standpoint of an auditor, okay, which is how I look at almost everything. So the company tells me to have $117,000 cash at year end, right? How would I get proof that this cash exists? And what I would do is I would ask the bank for a bank cutoff statement. And that bank cutoff statement will go about 15 days after year end. And then what I'll do is I'll account for transactions that happened between December 31st and the date of the bank cutoff statement. And I'll reconcile and tick and tie all of the different things that happened to prove to me that at December 31st, they did have $117,000 cash. And I get that information directly from the bank. I don't trust the company to give me some records to look at. They give me the financials. I go to the bank and say, give me the bank cutoff statement. And I see what the balance was at December 31st. And then I count for all the transactions that are sitting there that happened after December 31st. And I'm seeing what the bank balance is today. And then I'm satisfied that I'm really working back that at December 31st, they had this much cash. So if you want to know how much cash you have, look at your bank statement on your online banking. That's how much cash you actually have. This is telling you how much cash you had at December 31st.
Okay. Okay. That makes sense.
Yeah.
Thank you.
Okay. Okay, good. Now you come over and I have any other questions? Okay, so I will come over and I'm now going to go back to my journal and I'm going to start to do my closing entries. We call these closing entries, okay? And remember, we said last time, closing entries have two objectives. One, I need to turn my revenue, my expense, and my dividend accounts back to zero. I want to turn them back to zero so they're zero when I start the new year, because you keep track of your income by year. If someone asks you, hey, how much money did you make? You don't say, let's see, since I was born, let's see, my grandma gave me $5 one time. No, what happens? You report that by year. Yeah, last year I did pretty good. I'm getting up there. I think I got 120,000 last year. You tell what people your income by year, don't you? Okay. And so when the new year starts, what happens? Your pay stub goes back to zero, doesn't it? And they start keeping track of it for year two. Okay. So what happens? I need to turn these back, my revenue, my expenses back to zero because I'm going to keep track of my income by year. I keep track of my dividends by year. Okay. When we report the dividends, we're reporting the dividends for any given year. Okay. So I need to turn those back to zero. So since my revenue got credited over here and I increased it with that credit and it came up to this 200,000, to turn it back to zero now, to decrease it back to zero, I want to do what? I want to debit my revenue 200,000. Okay. So when I go ahead and I debit my revenue 200,000, okay, the balance is now zero. Did I accomplish my objective? I debited revenue zero. I posted the debit over here to revenue zero. I debited over here for 200,000. I posted my debit over here 200,000 and that put it back to what? That put it back to zero. Is that what I wanted? Okay. Now, debits have to equal credits, right? So what happens? I debited revenue. I have to credit something. I'm going to credit this sort of holding account called income summary. An income summary is kind of a cool account because as I close my accounts, it'll show me what's gone on for the year. So what happens? I credit income summary over here. And when I post it over here, income summary now shows what? Now shows 200,000, which is my revenue. Okay. Good. Got my revenue closed. Now I want to close my expenses. I need to close my revenue, expenses, and my dividends. Turn them back to zero. So I go ahead and I do what? Since up here I had debited right there. I had debited my expense. To close it, I'm going to what? Credit it. When I credit the expense, I credit it for 70,000. And when I credit it, is that what I wanted? I wanted it back to zero, didn't I? So now my expenses are zero, my revenues are zero. If I credit my expenses, I have to debit something. I debit what? I debit income summary. And when I debit income summary over here, right, I credited it, it came up to 200,000. Now I'm debiting it, and it now shows 130,000. What was my net income? 130,000.
130.
Income summary is kind of a cool account because now it shows me what my income was. Now, this 130,000, my net income sits here going, help, help. And I say, what's wrong? I want to go home. Well, where do you live? I live in retained earnings. Can you give me a ride to retained earnings? Sure, I'll give you a ride to retained earnings, no problem. I don't know why this sounds creepy, but okay, sure. I'll take it to retained earnings, no problem, okay? So I've got to get it out of income summary and into retained earnings. Now, right now, there's a $130,000 credit balance sitting there in my income summary. So what am I going to do? To get it out of income summary, I'll debit it, 130,000. When I debit it, right, now my income summary shows zero. Okay, beautiful. That's zero. That's what I want because my income summary got to show zero, just like my revenue and expenses and my dividends are going to show zero because I want to keep track of my income by year. So I need it also to be back to zero. So that's done. And I have to credit what? I credit retained earnings. And when I credit my retained earnings over here for 130,000 to increase an equity account like retained earnings, you credit it. So that credit is going to increase my retained earnings. And so I'm going to go ahead and for this one, I'm going to write it in credit retained earnings. What? I'm just posting that now. 130,000. That brings the balance up to what? 130,000. The 130,000, my net income says, thank you. I gave it a ride home, didn't I? It's where it belongs now. It's in retained earnings. Okay. So now my what? Revenue is zero. My expenses are zero because I want to start the new year with zero there. My what? My income summary is zero. Now I just got to work on dividends. I got to get that to zero because I keep track of my dividend by year. When companies tell you on their statement of retained earnings, this is the dividend, that's the dividend that they paid that year. Okay, or declared anyway that year. So I go ahead and I do what? I credit dividend. I'm going to start with the credit here. I credit dividend 13,000. When I credit dividend 13,000, I post that credit over here. That brings it to zero. I'm there. I got my revenue, expenses, dividend, income summary, all zero. Beautiful. But I have to finish that journal entry. I have to debit something. I debit retained earnings. To decrease retained earnings, you debit it. It is a equity account. To decrease retained earnings, you debit it. And I'm going to write that one in when I put in that debit for 13,000. That brings the balance to 117. These closing entries are beautiful. I just accomplished the objectives of the closing entry, which is to turn revenue to zero, expenses to zero, dividends to zero, income summary is zero. And now the amount in my retained earnings, the 117, matches with what? What I said the ending balance was on my statement of retained earnings, what I said the ending balance was on my balance sheet. The world is beautiful.
John, I had a question. Sorry. I might be getting the terminologies wrong, but can't you have like a carried over? Because I do my taxes through TurboTax every year, and I remember something about carried over losses. That's not like the expense, right? Can't have a
That's a tax question. We don't do tax in this
Okay,
class.
okay, got it.
Okay, but I'll just quickly say that the law is that you can carry forward losses 20 years. They used to have a 3-year carry back, but when they did the Jobs and Tax Cut Act, they decreased the corporate tax rates, but the government giveth, the government taketh away. You know, they kept saying it was tax reform. It wasn't tax reform. It was a tax cut. Tax reform, okay, I'm going to get into my, bureaucratic wonkiness here. Tax reform means that it is revenue neutral, is budget neutral. So that means that for every cut you give, you raise tax somewhere else, and that makes it neutral. This was a pure tax cut, okay? But there was a number of things that they did so that the cut wouldn't add to the deficit too much, which it added to a lot, but so that it just wouldn't completely blow a hole. Well, it did blow a hole in the deficit. To give themselves political cover, what they did was they sat there and they said, well, we're going to lower the corporate tax rate from whatever it was, 30, 40% down to 20%, but we're going to take away your ability to carry back losses. So if I had income in the past, I could carry my loss back and get a refund on my tax for that. They got rid of that, but you can carry losses forward still. Okay, which means if you have income in the future, you can use those past losses to write off against your future income when it happens. But that's really beyond the scope of this class. Okay, so we're talking about financial reporting, and for financial reporting, there is no such thing as a carry back, a carry forward for my revenues, my expenses, my dividends, my income. They simply all turn back to zero, and you start keeping track of them again the next year.
Got it. Thank you. Appreciate it.
Yeah. Okay. Okay, good. Now you come over and you look, my revenue is zero. My expenses are zero. My dividends are zero. My income summary is zero. Good. But look at my balance sheet accounts, guys. They still have balances in them, don't they? My cash is still what? Showing 117. My equipment's still 150. My building's still 1.2, etc. Well, should that be the case? Answer, yes. It should be the case. What happens? You fall asleep with $117,000 in your wallet on New Year's Eve. You wake up the next morning, unless you got some really shady friends, is that 117,000 still in there? Yeah. Is the building still there? Yeah. Is your car still in front of the house and still out in the vehicle still out in front? Yes. Do you still owe the guy $200,000? Yeah, he doesn't say, oh no, that was last year. You didn't pay me by the end of the year. Ooh, you don't owe me that. Good move. You didn't pay me, so you don't know the guy's he may be knocking at the door the next day. Hey, give me my money, right? And so what happens? All of the balance sheet accounts roll forward to the next year. So your balance sheet is like your wallet. Everything that was there when the clock strikes 12 is still there when the clock strikes 12, or everything that was there at 11:59 is still there when the clock strikes 12, right? Okay. Okay. So if you look at year 2, notice that's exactly where we start year 2. We have our beginning balance, last year's ending balance in the cash account, right? Last year's ending balance, 117, is year 2's what? Beginning balance. Last year's ending balance of equipment, 150, is this year's beginning balance. Okay, same thing for the building. There's those liabilities. There's my buddy what? There's my buddy common stock. That's still showing $1 million. It ended the year with $1 million. It's going to start the year with $1 million. I guess I should have put beginning balance, whatever. And what? The retained earnings beginning balance, last year's ending balance is this year's beginning balance. Remember, retained earnings is the record of all my earnings minus dividend over the entire life of the company. So I've got to start with this 117 to start year 2, right? And then I look at my revenue, yeah, it starts the year with 0. Expenses start the year with 0. Income summary starts the year with 0. Dividends start the year with what? 0, right? That's the beginning balance. Okay. So now we're going to proceed, we're going to take a break, and then we're going to proceed with year 2. But before we take the break, and now I probably lost all commitment to you to ask me any questions, but since I said the word break, but before we start the break, any question before we take a break and then start on year 2?
Quick question. This isn't related to this, but what's a primary user of accounting? Because I got different information on the internet. This was a question on one of the practice midterms, so I figured I'd just ask it now to get out of the way.
Well, what did you see on the internet out of curiosity?
A couple websites said that it consisted of external users, and then other sources said it was internal. But the question had all external users, and then creditors were said to be primary users. And then I found nothing in the book talking about it either, so I figured I'd ask.
You saw something in the book that said it could be either?
No, I saw nothing in the book even talking about it.
Really? Well, who did we attribute that to?
We said it was creditors. Which of the following is a primary user of accounting information?
Who did we attribute that to when we were talking about it? When we were talking about it, who did we attribute it to?
I don't know.
Okay. When we were talking about it, we attributed it to the Financial Accounting Standards Board, didn't we? So is that where you went, where you saw that they were saying that it could be internal users?
Possibly, yeah. I can't remember exactly where I looked. I just remember there was a lot of mixed information.
Oh, there's a lot of mixed information. There's all kinds of things out there. I mean, there's some websites that'll tell you that the world is flat. Okay, so yeah, there's all kinds of mixed information. I'm asking you, did you see something where the Financial Accounting Standards Board told you, stated that users were internal, primary users were internal?
Not that I remember, no. I mean, it could have been. It was a couple days ago, not.
Yeah. So basically, the authoritative source of who we define as primary users comes from the Financial Accounting Standards Board. And the Financial Accounting Standards Board has determined that primary users are investors and creditors. Now, there are other external users that would include things like regulatory agencies, and we gave example of Security Exchange Commission and IRS as external users, regulatory entities like that, but they are not considered primary users, okay? Internal users are not primary users because our two primary users are external, investors and creditors. And so I'm not sure what you saw that said internal users were primary users.
Okay, sounds good, thank you.
And the reason it's important from the FASB standpoint, it's their job to sit there and tell companies what they have to put into their financial statements, right? And so the FASB had to sit back way back when it did its conceptual framework and say, well, okay, if we're going to tell companies what to put in their financial statements, we can't tell them, hey, put everything that we got drunk and decided you should put in there. They sit there, you're going to put things in your financial statements that we believe will benefit those outside the company, because that's where those financial statements are going to be used. Because when you're making when you want to get listed on the stock exchanges, there's a requirement that you provide financial information, not to yourself, but to those outside the company, so they can make what kind of decisions, so that they can make investment and credit decisions. So who are users? Those outside the company. And hey, look, IRS, you may want us to put all kinds of things in the financial statements that will help you do your job. That's not our problem. Okay, you have audit authority over these entities. If you want some information, you have all kinds of tools to get the information. SEC, you can subpoena people to get the information that you want, or just walk in and demand it at any point in time through your regulatory authority through the Securities Acts of 33 and 34. We're interested in those people out there that don't have the right to demand information from the company. These are what? These are investors and creditors that have to rely on information that is generally published. And so when we ask them to provide information to those individuals, they're the first ones we think about. Okay. And internal users, FASB doesn't have to worry about them. You're internal. You have all the information you want internally. Okay. Okay. Any other question before we take the break? Okay, good. So I'm showing about 7:15, guys. Let's just make it, I don't know, I guess 7:26 and a half. Okay, we'll make it 7:26. We'll take, is 10 minutes okay? 7:27? Let's make it 7:30. Make it silly. Okay, we'll come back at 7:30. Okay. All right, guys, I want to go ahead and get us started back. So we'll finish year 2 for sure, but I just want to go ahead and jump us in, okay? So let's just go ahead and let's take a look at year 2 here now. And again, remember our revenues, our expenses, our dividends, our income summary will all show 0. Our balance sheet accounts will show beginning balances, right? So we start into year 2 and we say here service is provided on account. Now, one of the challenges for you is going to be getting used to how we articulate different things to you or communicate different things to you using sort of the parlance of accounting. If we say that service is provided on account, that means that we have earned the revenue, okay? We've done the service, but we're going to get paid later, okay? So what happens? We go ahead, and since we've provided the service, even though we're going to get paid later, under accrual accounting, that doesn't matter. We can go ahead and take that full amount of revenue as soon as we provided the service. So we credit revenue down here for the 100,000, and the balance now goes up from 0 to 100,000 as we now start to track our revenue for year 2. Okay. Now we're not going to get paid cash up front. We are going to receive the money later. So we have an account receivable, meaning that money's going to come in later. Okay. And so what happens? We go ahead, we can't debit cash yet, but we can debit the asset account receivable because that will be cash at some point in time here, right? And so it has future economic benefit. It's an asset, debit on the left, credit on the right, post to the journal, from the journal, post to the ledger. We post to the accounts receivable, we got 100,000, okay? Now, don't tell anybody, but we've been driving our vehicle without insurance. And so we said, oh, we better get some insurance, right? So we call on our insurance guy and we say, hey, I need to get some vehicle insurance. And the guy says, oh, okay, good deal. I'll get you 2 years coverage of insurance and it's going to cost you $600 a year. All you got to do is you got to pay me up front, the full $1,200 for the full 2 years. No problem. So what do? I'm of course going to credit cash for $1,200 because I'm going to pay that policy, right? So my cash started out the year with 117. It comes down a little bit. And now I'm going to sit here and I'm going to debit the asset. Prepaid insurance, prepaid is telling you it's an asset because it's saying, hey, you prepaid something. You've got future economic benefit here. You've got 2 years of insurance coverage, all of year 2 and all of year 3. This thing will finally expire at the end of year 3. So I've got 2 years prepaid, paid that at the beginning of year 2. It's going to cover all of year 2. It's going to cover all of year 3. So I debit prepaid insurance, $1,200. Okay. Okay, good. Now here comes that question, or here comes the answer to that question that we had sort of put in the context of a deposit. So what happens? We're still DJ Pizzazz, aren't we? So one day some, high roller comes in and says to us, hey, I understand you're one of the best DJs around. Yeah, we're growing, we're in our DJ Pizzazz outfit. And the high roller says, well, look, I'm going to throw a party every month for the next year. And she comes in on July 1st and tells us that she's going to do this. Okay. On July 1st, she comes in. Let me move that thing out of the way. She comes in on July 1st and says, look, here's the deal. Because you're DJ Pizzazz, you're an up and coming DJ, and I want you to be my DJ. What I'm going to do is I'm going to give you $120,000. And that $120,000 is going to cover each month's concert. I'll give you $10,000 for each month, but I want you to be available. And the first concert is going to be July 31st. The next concert, I'm going to have end of months, parties, and you're going to be the DJ for it. The next one will be August, September, October, so on. Okay, but here's the $120,000. I'm paying you in advance. You better show up. If you don't show up, I'm going to have my boys come talk to you. Okay, so say, hey, are you going to take that money? Yeah, someone handing you $120,000, you're like, okay, yeah, please give it to me, right? So what happens? You go ahead, you get that $120,000, okay? And so when you do that, you debit cash $120. Now my cash balance is coming up pretty nice now, right? So my cash balance is now what? $120, but I have to credit the liability unearned revenue, because when she handed me the money July 1st, the first concert wasn't going to happen till the end of the month. So I hadn't earned any of that revenue yet. If I somehow, Irving has a nervous breakdown and says, I can't be DJ anymore, now I'm going to have to do what? Before I provide that first concert, that first party DJing, I'm going to have to give her that money back, right? Okay. So I have an obligation, a liability to now perform that service. So I go ahead and I do what? I credit unearned revenue. Okay. I can't credit revenue yet. I have to credit the liability unearned revenue. And when I credit that liability, my unearned revenue liability account comes up. It's a liability. So I credited it to increase it. And that's showing the world that what? I'm on the hook to provide that service. I'm on the hook to provide that service. So yeah, it's a deposit. When you get a deposit like that, that deposit is treated as a liability. And if it's a deposit in advance of doing future work, we call that unearned revenue. Does that answer the question we had earlier?
Yes, it does. Thank you. It's like crystal.
Okay, great. All right. Okay, good. So then we go ahead and we need some DJ wipes. Our equipment gets all sweaty, people dancing, and back in the day, remember when people would go and dance places, right? And they spill stuff. And so I need something to clean my equipment up. Okay, I need some DJ wipes. Okay, so I go to the DJ supply store and I walk in and I get myself $24,000 worth of supplies, DJ wipes, whatever. Okay, and so what happens? Those have future economic benefit. I buy supplies that are going to last me maybe a couple years or something. I get a bunch of supplies, right? So I go ahead and I'm going to take those supplies. I debit supplies because they have future economic benefit. Now I reach into my pocket to pay the DJ supply store guy, and he says, wait a minute, aren't you I know your shirt says Irving, but aren't you DJ Pizzazz? And I said, well, yeah, I am. Don't tell anybody. He said, no, no, no. I hear you're an up and coming DJ. I'll tell you what, no charge. You don't have to pay me right now. Pay me next year. Don't worry about it. You don't have to pay me now. Now, the DJ supply store guy does that for many reasons. Primarily, he thinks, hey, this guy's rolling. He'll be, bigger than the dead mouse guy someday. So I want this guy to keep coming to my DJ supply store, okay, forever. Okay, so he extends me credit. So when that happens, he's going to bill me later. I'm going to have an account payable. And so I will credit the liability account payable. And so I post that over to my ledger. And now I have a new liability here now, accounts payable. Still got the mortgage payable, still got the vehicle payable because I haven't paid anything on these yet, right? Okay. Okay, good. Then what? Then that first concert that I had provided in year 2, the first concert of year 2, remember they were supposed to pay me that $100,000 and they call me and they say, hey, can I just give you $40,000 now? I'll give you the rest later. And they're a good customer. I know they're good for it. So yeah, don't worry about it. Yeah, just pay me 40 now. You can pay me the rest later. Okay. So when they pay me the cash, I of course debit cash because my cash has gone up. And I credit accounts receivable. When I credit the account receivable, now it's showing that the guy still owes me, or I think it was, I don't know if it was a he or she now, but they still owe me what? They still owe me $60,000 at this point. Okay. Guys, this right here is why they invented accounting. Think about it. Back in the 12th century, if somebody owed you money, right, or maybe if you owed them money and there was a payment made on that, we want to keep good track of that because in those days, if you owed somebody money and they said you didn't pay them, you could end up, rowing a ship or something at the bottom, right? And so what happens is a big deal to make sure that you knew what was owed to you, that you knew what others owed to you, what you owed to others. This is the reason they came up with accounting. And this is beautiful. If they call me later and say, hey, how much do I owe you? I don't want them hearing me trying to rustle through my papers, trying to figure it out. I want to be able to say to them, 40,000. They said, what is it? Not 40,000, 60,000, 60,000. Before they said, wait, I'm not even done talking yet. So I said, you owe me 60,000. I want you to know that. Okay. So we come right out with what it is they owe us at any point in time. Okay. So we know that we still got what? 60,000 coming. Okay. Now, remember we got that 120,000 from her for the concerts, for the parties, whatever. They paid us in advance. And let's say we do the concert July 31st. We do the concert August 31st. We do the concert September 30th. We do the concert, the Halloween concert, October 31st for the Halloween party, November 30th. And then we do our New Year's Eve, December 31st party. So at this point, by the end of the year, we have done the work for now what? 6 of those parties. I don't know if you can see 6 fingers or not. 6 of those parties, right? We've done it for 6 parties now. Now, let's say we didn't account for those parties as we did them each month. We get to the end of the year now, we're going to do something called adjusting entries. Adjusting entry says things aren't quite right. If your tie is crooked, what do? You adjust it, you fix it because it's not quite right, right? We're to the end of the year, we're going to do adjusting entries. We're going to look at some things and say, uh-oh, there were some things that we didn't account for during the year. Let's adjust for that now, okay? So we look at our books and we say, uh-oh, we've already done 6 of those concerts. It was what? 10,000 per concert. 10,000 times 6 months is what? 60,000 of that money that she gave me up front. She gave me 120. I've now earned 6 months of that. I've earned 60,000. So what do? Now I can credit revenue 60,000. Why? Because I did the work now. So now I credit revenue 60,000. That's for those parties that I've DJ'd for now. I don't want to go through the months again, but those 6 months. So I go ahead and I credit revenue for 60,000. Now I can reduce the liability because I'm only on the hook now for what? The remaining 6 concerts that will be in January, February, March, April, May, June. I got 6 concerts left to go, but those won't happen until next year. So when I make this adjustment, notice that I debit my unearned revenue, and my unearned revenue liability goes from what? Goes from the 120. Now it goes down to 60,000. Isn't accounting beautiful? Have you seen anything more beautiful in your entire life? Look at that. It's sitting there showing you I've got 6 months left at what? 10,000 a month. I've got 60,000 left that I still have to perform for. Question. Okay, good. So let's think about this for a second, guys. Here, I took the revenue, even though I hadn't received the money yet, because I'd already provided the service, right? Here, what happened? I got the money, but I couldn't take the revenue yet because I hadn't provided the service yet. This is accrual accounting. I had to wait to recognize the revenue until I had what? Actually performed the service. That was for my July through December 31st concerts. And I still got 6 to go, right? Okay, good. Now I continue my adjusting entries now, okay? And I'm saying, uh-oh, a year's gone by. I paid my insurance premium $1,200 at the beginning of the year to cover 2 years. 1,200 divided by 2 is 600 a year. A year's gone by now. So what? Half of that 1,200 has expired. So I have to do what? I have to debit expense, right? It has expired. I debit expense 600. When I debit expense 600, coming over to my expenses, okay, my beginning balance in my expense was 0 because I start the year with 0. But now I debit expense $600 because now some of that prepaid, that asset has expired. There's no more future economic benefit. It's expired. I debit expense 600. I credit the prepaid 600. Okay, first I enter it into the journal, then I post it over here to the ledger. And when I post it, now it's sitting there and showing me, okay, prepaid insurance is now $600. That's what? That's the 1 year I still have left of insurance coverage. Okay. Okay, stop me if there's a question. Okay, now we're making adjusting entries. And remember that $24,000 worth of supplies we bought? Okay, well now we go to the DJ supply closet and we go and we count and we see that there's only 13,000 of supplies that are left. Okay, well let me ask you a question. If Johnny had 24,000 apples and then he counts at the end of the year and he only has 13,000 apples left, how many apples did Johnny eat? Johnny ate what? 11,000 apples have expired, haven't they? Okay, so if I had 24,000 worth of supplies in the closet, later on I open up the closet and there's only what? 13,000 supplies left, then 11,000 have expired. They either got used or somebody stole them, but they ain't there no more. They've expired, haven't they? Okay, so what do? I debit supplies expense for 11,000. I post that over to my expense account, 11,000. Now that's gone up another 11,000. It's now 11,600. And I do what? I credit the asset supplies. And when I credit the asset supplies, the supplies account now shows 13,000. How much was left in the supply closet? 13,000. How beautiful is this? I go ahead, I credit supplies, and now the supply account is showing what's left in the supply closet, what I counted. Okay. All right, good. Now, we're not going to look at depreciation until chapter 8, our second midterm. So I'm not going to ask you anything about depreciation on your first midterm. Okay. But I know that in the back of your mind, students have this notion of depreciation. This might be bothering you a little bit. So I'm just going to show you that we would depreciate probably both the vehicle and the building, but I'm just going to show you the building here. Okay, so what happens? When you buy a vehicle, you buy a building, it's nice and shiny new, everything's perfect, right? 1 year later, is it still shiny perfect? No. The doors are a little dinged up now. The rug is not as beautiful. It's lost the new building smell. Okay, so what happens? Things get older as time goes by. Now, that means that some of the future economic benefit of that building in this example has expired. So I go ahead and I estimate that 50,000 has expired. So I debit my depreciation expense, 50,000. And I go ahead now, my expenses are 61.6 now, adding it to my other expenses. And then I credit an account called accumulated depreciation. Sometimes students want to take that straight to the building account. We don't do it that way because when we prepare our financials, remember, we're doing all this nonsense because we want to prepare a set of financials. When we prepare our financials now, the balance sheet will still show what we originally paid for that building. And then there will be a credit against that, a subtract against that. They call it a contra asset account that shows how much of that building has depreciated. So users can look and they can say, okay, you paid 1.2, it's depreciated 50,000. You still got a long way to go before that building is really old. If you're sitting there in they paid 1.2 and they're showing $1 million of accumulated depreciation, you're saying, whoa, that building's about gone, man. They've got They've got a big cash outlay that's coming they're going to incur a huge liability when they have to replace that building pretty soon. So we present it in a manner so someone can see basically how old that building is by seeing the difference between what we paid and what we have accumulated in expired costs, accumulated depreciation, because we debited our expense each year as that building got older and older. Okay. Okay. Question?
So would each asset have its own accumulated depreciation account?
In our subsidiary records, absolutely. Okay, subsidiary records are the records that underlie the general ledger. So we have subsidiary ledgers, and then we have a general ledger. And so, yeah, at a subsidiary, at a lower level, yes, but no, I mean, companies can have, can you imagine if FedEx showed you the depreciation schedule for every single vehicle it owns? No. All right, so they're going to show you total equipment, total depreciation for a whole variety of different types of, that will constitute, which will be constituted of a whole bunch of different assets they hold, right?
Okay.
Yeah.
Thanks.
Mm-hmm. Okay, good. Now, but yeah, we would need that at a subsidiary level because, each asset has its own. Now, there are some techniques of depreciation, what they call group depreciation. And with group depreciation, way beyond the scope of this class, you could start to group certain things together and how you depreciate them. But for the most part, you're not going to have one big equipment account, one big depreciation account. Okay, so let's go ahead and let's take a look now at the preparation of financial statement, shall we? Okay, so what financial statement are we going to prepare first?
Income.
Good. Excellent. Income statement. What do we put on the income statement?
Net income.
Good. Beautiful. How do you calculate net income? Revenue minus
Expenses.
expenses. Good. Do we have any revenue? Yep. We got what, 160,000 this year? Keep track of our revenue by year, right? Last year it was what, 200,000? This year it's 160,000. Okay. Do we have any expenses? Okay.
Yes.
Yeah. 61.6.
6.
Okay. Good. Revenue minus expenses. We report that on the income statement because revenue minus expenses is, let me write net in here, net income, right? So that's what, 98,400 or something stupid like that? Okay. Do I have a second on that?
Second.
I'll go out on a limb.
Okay, good. Never do that. Never go out on a limb when it comes to
Yeah, I didn't think I should, but
you know why? Because the SEC is going to sit there with a saw on the other side. Okay. All right. So what happens? Sorry, guys. What statement is second?
Retained earnings statement.
Good. Statement of retained earnings. Good. Okay. And so we're going to have a beginning balance. I write that over a little bit, sorry. We're going to have a beginning balance. What am I doing? Okay, how much is the beginning balance?
117,000.
Good, just look at your beginning balance right here. That's what these ledgers are here for, to help us prepare the financial statements, right? So I've got a beginning balance of 117. What do I add?
Net income.
Good, I add net income. I'm going to spare you the drawing of the piggy bank. My net income is what? 98.4? 98,400. Okay, good. I subtract what?
Dividends.
Dividends.
Good. I subtract dividend. And when I look at my dividend, did I pay any dividends this year?
No.
No. You don't have to. DJ Pizzazz is looking and saying, hey, I pulled out 13,000 last year. I'm good. I'm cool. I don't need to take any more out. You don't have to pay dividend. Boards of directors make decisions about dividends depending on what's going on with the company. Some years they may, some years they may not. It just really depends, and they declare it when they decide they want to pay a dividend. Okay, you can't force them to. So what happens? These subtract dividend. Huh? Was that a yawn?
Sorry.
It's all right. As long as I don't hear your head hit the table, you're okay. Or I had a student that came to my office hour, not from this class today. Says, "Well, I've tried to watch your lecture and I keep falling asleep." Okay, what do you want? What am I gonna do? I'm not a sleeping coach.
It's
Or-
not you, it's the lack of coffee.
Oh, okay. Well, here you go. Okay, I'm drinking coffee all hours of the day. Okay, so what happens? We have the ending balance. Okay, and ending balance is what? 117 plus 98.4, and that gives me a total here of what? Huh?
Sorry, I was doing it in my head.
Never do that.
Is it 10,600?
How much?
215. 400.
215,400,
Not bad.
like that? Yeah?
Yeah.
Okay. Okay, good. That's my ending balance now in my retained earnings. And so now what statement do I prepare third? Third comes the balance sheet. Good. Why do they call it a balance sheet?
Because it balances.
Because it balances. Good. What balances?
Assets equals
Assets
liabilities plus.
The stockholders' equity. Good. So those are the accounts. Excellent, guys. So those are the accounts that I have to pick up here. So I start with my assets. Do I have any assets? And I look up here and I have cash, don't I? Is that an asset?
Oh yeah.
Yeah, my favorite. I got 275,800. Not bad. So my cash is 275,800. That's a comma. Commas are terrible. Okay, good. Any other assets up here? I'll tell you what, humor me, guys. I want to put accounts receivable next. Is that an asset? Accounts receivable an asset?
Yes.
Okay, that's going to be cash pretty soon, isn't it? Okay. In this class, we will abbreviate accounts receivable AR. Okay. So my accounts receivable was, what was it? 40,000 or 60,000? 60,000?
Yes.
Okay, good. What's that? Lullaby music now? Okay. So then what? Then we come over and we look and we have what? Some supplies. 13,000 of DJ wipes left. Is that an asset?
Yeah.
That got future economic benefit. Supplies are 13,000. Do I have any insurance left?
$600.
I got 600 prepaid insurance left, right? Right there. Okay. So prepaid insurance is 600. Okay, good. Any more assets? Let's see. I've got equipment and I've got building, don't I? Okay. So first, I'm going to write in my equipment. Which we said was 150,000. Then I'm going to write in what? Building. Okay. And the building, don't get creative. Don't use your imagination unless I tell you to. You just look up here and building shows how much? 1,200,000. I picked that up. And then I report the accumulated depreciation.
I have a question. Why are we considering accumulated depreciation in the assets?
I'm not considering an asset. I'm considering it a contra asset.
Got it.
It goes against, contra means against.
Yeah.
It goes against the assets. So my asset building is a debit. The accumulated depreciation is a credit.
Mm-hmm.
Right? So it's against, so that when I report it down here as accumulated depreciation of 50,000,
Mm-hmm.
that contra asset allows the user, the financial statement, to say, okay, you got a building that you paid 1.2 million for. Well, it's not brand new. It's a little older. Next year, that'll be 100,000. Next year after that, it'll be, eventually that's going to be what? $1 million. And then someone's going to look and say, wow, that's a really, really old building, right?
Mm-hmm.
So I report it as a contra asset. I report it what? Against the asset that it's related to. Okay. Okay, good. Any more assets, contra assets here? I don't think so, right? I think we got them all. Okay. So now I'm going to go ahead and ask you to use your calculator to give me my total assets. $275, 800 plus 60 plus 13 plus 6 plus 150 plus 1.2 minus 50,000. Right? That's a contra. That's an opposite. So you have to subtract it. Gives me how much? 1,649,000 what?
400.
400. Okay, good. Thank you. Do I have a second on that? Do I have any objections to that? Okay, I'm going to assume that means it's okay. So now I'm going to do my liabilities. And guys, this is, somebody said, well, in the real world, and the only thing about this example that's not real world is the fact that we haven't paid anything yet on these liabilities, because by year 2, we certainly would have started to pay on these. The reason I say the only thing about this is not real world, I mean, you could have a business that has all these kinds of transactions, right? But it would probably be unrealistic that you wouldn't have paid on these, but I don't want to turn this into a 3-day example. So I've got what? Mortgage payable, vehicle payable. Okay, of 150,000. And the vehicle payable is 150. The mortgage payable is 200. Let's just pick those two up. Mort payable is still sitting there at 200,000. Vehicle payable is 150,000. Right, we hadn't paid anything on those. How about any other liabilities? Account payable, 24,000. Okay, notice guys, even though some of the supplies have been used up, I still owe the guy the 24,000, right? So the supplies account has come down, but I still owe the guy the full 24,000. He said, hey, don't worry about it. Pay me in a couple years or whatever. Okay, no one's going to tell you that, but just pretend. Okay, so the account payable in this class will always be AP is 24,000. Line up your numbers, John. Do a better job line up your numbers. When I was in the I think it was like the 2nd grade or something like that, I had this teacher. No, it was more like the 1st grade. This teacher, I could never line up the numbers. And the teacher said, you don't line your numbers up, you're never going to do anything with numbers in your life. Okay, to her. Okay, wherever you are. Okay, so what happens? You got the 24,000 is the account payable. Okay, 24,000. Okay, then what? Is unearned revenue a liability? Yeah, I treat it as a liability. Now, analysts will look at that unearned revenue account a little differently and say, I like that liability because that means they might track it year over year. That means that person has business constantly going into the next year. They're in demand, right? So that might be a liability that's looked at a little bit differently. Okay. So I have what? Unearned revenue of 60,000. It's still a liability though. If I came back and, like I said, DJ Pizzazz Irving has a nervous breakdown and says, I can't do this anymore. I'm just not I'm not a DJ. I'm not a DJ in my heart. Then they're going to have to give that 60,000 back, right? Okay. So we go ahead. We put that as a liability. Any other liabilities? No, that looks like everything, right? Okay, so I go ahead and with my calculator, I add up the total liabilities. Total liabilities, guys. With my calculator, 350 plus 24 plus 60 is
434.
434,000.
434,000 even?
Yeah.
Yeah?
Yep.
Okay, good. Okay, good. Now I can do my stockholders' equity. SHE is how we abbreviate stockholders' equity, SHE, stockholders' equity. And I come over and I have common stock still of 1 million, right? Haven't issued any more stock. It's that original amount I issued. That's still what's outstanding. So I just go ahead and put in common stock of 1 million. And what's the other part of my stockholders' equity? Two accounts make up stockholders' equity. What are they?
Common stock and retained earnings.
Good.
Mhm.
So my retained earnings, my RE, where am I going to get the retained earnings balance right now? Right now, I got to do what? Bring it down from the statement of retained earnings because I haven't done my closing entries yet. I can't look at the retained earnings account because I haven't closed things out to retained earnings yet. So I got to bring that down. What is it, guys? To what? 215, 400?
Yeah.
So now my total stockholders' equity is 1,215,400. I trust myself to do that in my head. And then I add my what? My liabilities plus my stockholders' equity. So total liabilities plus stockholders' equity equals, anybody add those two numbers together yet?
649400.
649400, you say? Okay. I have a second on that.
Hello?
Yeah.
Hey, where are you?
We're right here. Where's the party?
Uh-huh.
Okay. So 1,649,400. Does it balance?
Yeah.
Okay. Did any rabbits jump out of any hats? Not magic, guys. It's simply doing what? It's simply sitting here and following the system of debits and credits. To increase an asset, you debit it. To increase liability, you credit it. Sitting here following that keeps this thing in balance, right? Okay. So now our only job is to do what? To do the closing entries. Okay. And the objective of the closing entry is to do what? Turn revenues back to zero, expenses back to zero, dividends already zero because we didn't have any dividends this year. And then to do what? Get the retained earnings balance that's showing on the statement of retained earnings and on the balance sheet, get that to match what's in the ledger. Okay. So I go ahead, my revenues during the year, that first concert was 100,000. That DJing that I did for the first 6 months of that contract, July through December, was 60. So I had credited revenue for a total of 160. To close it, I'm going to do what? I'm going to debit it 160. When I debit it 160, now my revenue balance goes down to zero. Is that what I wanted? Yeah, I need to close it to zero, right? my expenses, and I have to, don't go too fast, John. I have to do what? I have to credit something. If I debited my expenses, I have to credit something. I credit what? I credit income summary. And when I credit income summary, my income summary for a second shows me my revenue for the year, the 160. But then I'm going to do what? I'm going to close my expenses. And when I close my expenses during the year for those various things, I had debited it for 61.6 total. Now I'm going to credit it for 61.6. And when I credit it for 61.6, that will close my expenses. That's now 0. Okay. And I've got to debit something. I debit what? I debit income summary. Debits have to always equal credits. I debit my income summary 61.6. And when I do, now the balance in the income summary account shows what? Shows 98.4. So there's net income, again, trapped in income summary saying, help, take me to retained earnings. Okay, I'll give you a ride to retain earnings, right? Did it last year, I'll do it this year. So I go ahead and I do what? I debit income summary 98.4. When I debit income summary 98.4, that closes out my income summary. It's back to 0 because I need to keep track of my revenue, my expenses, my dividends, my income by year. So everything is now at 0. Dividends had no activity for the year, so it just stays at 0. And I go ahead and I got to credit something. I credit retained earnings. And when I credit retained earnings, there we go. Now my what? Now my retained earnings is up 98.4. It's now has a balance, the 117 beginning minus the, not minus, but plus the 98.4 for my income for this year makes it 215,400, which is what's showing on the statement of retained earnings. That's what's showing on the balance sheet. Everything's beautiful. And if you think about retained earnings, what is it? It's the 130 minus the 13 plus the 98, what was it, 98.4 net income for this year is how I got to this balance now of 215,400. Question? No? Did I hear somebody crying?
No, it's not crying.
Okay. Okay, good. Now, if you're crying, if you're thinking about crying because you think, really? I mean, poor accountants, they really have to go through all this? Is that no wonder all my friends who are accountants seem so miserable? Okay, well, there's probably other reasons they're miserable. This, having to go through this is how it would be done if it was, 1962. Okay, people were just sitting around smoking indoors, drinking martinis at lunch, coming back to work, behaving inappropriately. This is how it would be done. Okay, what happens now because of the advent of software, right? General ledger software, we can do this in a much cleaner manner. Okay, much easier way, much more modern way of doing this. Now, the basic debits and credits are the same. So I need you to know how to increase an asset, how to decrease a liability. I need you to know to read a transaction and know how it's going to be entered into the journal. And I need you to understand how it's going to impact the ledger accounts and impact the financial statement. But I'm not interested in your ability to take a debit over here and stick it over there. We're not going to spend any time with that in any of the material I'm going to test you on. Okay. But I want to show you the way general ledger software would work. Okay, so let me go ahead and see if I can keep myself. Sorry, guys, if that says summer. I don't think that doesn't hurt anything. Sorry, it says summer. I know this is fall, but okay. And I'm going to go straight to chapter 2. There was nothing in the homework for chapter 1, so don't worry about that. Okay. And let's just go to it. And I think to make this more interesting, I need to go to student view. Did I tell you had to buy the Connect, or I said you don't have to, right? I didn't give you the URL yet, right?
No.
Okay, I'm going to give that to you now so you can go in and play around with this because you know enough now that I'll give you the URL pretty soon. Okay, I'll give that to you in the next couple of days or so. But I just want to show you how general ledger software works. Okay, but I don't want to do it like this. I'm going to do it like this. And I think it's question 7. Yeah, okay. All right, so what happens? We're going to go ahead and we're going to make entries into our journal, okay? And we'll make transaction in the journal, and then we're going to see how the software, general ledger software, would automatically post it to the ledger. This is what year is this? This is 2020. What year is this? 1920? This is 2020. My dad used to do that all the time. He'd be talking to me and say, yeah, you know, in 1920, Dad, you weren't even born. I mean, 2020. Okay, so what happens? We sit here and we're going to make this transaction. Casey Spade, owner, invested $100,750 cash in the company in exchange for common stock. So if cash came in, what account should I debit?
Asset.
Okay, asset is a category of accounts. We need to know what specific accounts, right? So what account should I debit?
Probably cash.
Cash.
Good. Cash, how much? 100,750. Okay, good. What should I credit then? Gotta have my credits have to equal my credits. My debits have to equal my credits.
On stock.
Good. I come down. There it is, common stock. Good. 100,750. I go ahead and I record that entry, and it accepts that entry, and I'm ready to do my second transaction. Okay. But before I do that, let's first think about what the general ledger is going to look like. The general ledger should show what 2 accounts now? I've only made an entry into 2 accounts, cash and common stock. So what 2 accounts should I see?
Assets and stockholders equity.
Okay, assets, stockholders equity are categories of accounts. I have a ledger for every single account.
You should see
Cash and common stock.
debit for cash
Good.
and a
I
credit.
should see a ledger, they call that a ledger card for cash and one for common stock. Yes, it is asset, it is stockholders equity, but I talk about accounts. I don't make debits to categories of accounts. I make debits and credits to what? Accounts. There it is. See how easy that was? I didn't have to post it over here and all that. Okay. Now, they have this thing, trial balance, and the idea of trial balance is a little old-fashioned, in that trial balance used to mean a lot more when there was a chance that I would accidentally put a different amount in for my debit and credit on a transaction. For example, I might debit cash 100,750 and accidentally credit common stock for 570. People used to make that kind of mistake all the time, transpose numbers. That doesn't happen anymore when you use general ledger software, because the software will have something called an internal control, a preventative control that won't accept an entry if the debits don't equal the credits. It'll go, and you'll go, why won't this go through? And it'll go, And if the computer could talk, it would say, you made a mistake. You don't know what you're doing. Your debits don't equal your credits. It won't accept the transaction if you don't have your debits and credits balanced. Now, you'll still hear people talk about a trial balance, but it's not really seeing if it balances. It's basically sitting there and saying, look, here's a rough look at what your financial statements are going to look like. And often a CEO or somebody like that will want to see the trial balance, even though they know you're not completely done with the financials, because they want to start to get a sense as to where things are trending for the month or something. Okay. But it's not to see if it balances anymore, because nowadays the software won't take an entry if it doesn't balance. Okay. So now I have my financial statements over here, okay? And I ask you, should I see anything on my income statement? Should there be any numbers on my income statement after this one transaction? Should there be any numbers on my income statement after this one transaction?
No.
Good. No numbers. Everything's zero because there were no accounts that that affected the income statement. Should I see anything on my statement of retained earnings? Don't answer too quickly. Retained earnings, beginning balance plus net income minus dividend gives me ending balance. Should I see anything on the statement of retained earnings?
No.
No, I haven't calculated any net income. I haven't said anything about dividends. So retained earnings, thank you, God, is what? Zero. Should I see anything in my balance sheet?
Yes.
Good. Balance sheet, what? Shows me total assets, cash, totals of my assets. No liabilities yet. Stockholders equity, just the common stock, right? Okay. So what I'm interested in, guys, is in your ability in this class to do what? To sit there and know what accounts get affected when you see a description of the transaction, what needs to be debited, what needs to be credited, and then I need you to be able to tell me what is the impact on the financial statement items. I don't care about this tab. They should get rid of it. This is stupid. I'm not interested in your ability to post from the journal to the ledger because a machine can do that. Okay?
So sorry, on an exam, would this be the format that we would go off of, posting it this way?
There is no posting on the exam. I'm not asking you to post from the journal to the ledger.
Okay.
I will have a description of a transaction and expect you to know what should be debited and what should be credited. And I may ask you, as a result of that transaction, did assets increase as a result of this transaction? As a result of this transaction, did the total assets increase?
Yeah.
Yes.
Yeah, cash.
Yeah, good. Did liabilities increase or decrease?
No.
Liabilities were unaffected, right? Did stockholders' equity increase?
Yes.
Yes, it did. Again, the account that you were supposed to credit was common stock, but my overall stockholders' equity did increase, right? Okay. Okay, good. Let's look at the next transaction. View, what do I want? View transaction list. Is that what I want? Okay. Okay, good. Number 2, the company purchased office supplies for $1,250. If I purchase office supplies for $1,250 cash, what should I credit?
Cash.
Good. Guys, you don't have to put the debit before the credit. Sometimes I have students, they sit there and they're killing themselves trying to figure out the answer to a question. because they can't remember the debit. Meanwhile, the credit is to cash. Free your mind, your ass will follow. If you sit there and you understand, okay, cash, oh, of course, it frees your up some thinking space. Of course, the debit, if I purchase supplies, has to go to what? How about office supplies?
Mhm.
Is that an asset?
Yes.
Yes.
Good. To increase it, I debit it. I go ahead, I stick that in there. I have to record the entry. I view the ledger. Well, but I'm going to ask you, what's in the ledger? What should my cash account go up or down?
Down.
Now,
Cash is going to be down, and now I'm going to have what? A new asset there, supplies?
Yep.
Right? And when I look at my income statement, my statement of earnings, nothing's happened there yet, right? But on the balance sheet, there it is. How much more beautiful is this than what we were doing?
A lot.
That's why I'm not interested in, can you sit here and do this mundane, tedious, horrible thing of going through all this? I'm interested, do you understand how it works, the impact? Do you understand what the machine is doing when you enter those debits and credits, right? Okay. Okay, let's do, I don't want to sit here and, we're gonna go into a coma if we do every single one of these. So let's just do this January 4th one. The company received 15,500 cash. Okay, so where do I have to go to see this? I want to go back to the general journal. I'm going to go back to the transaction list. 15,500 cash for fees and services. Okay, so if I got cash, what do you want me to debit?
Cash.
Good, 15.5. Beautiful. If I provided a service, what do you want me to credit?
Revenue.
Revenue.
Good. Now, this question is kind of interesting in that they have a couple of different types of revenue. Okay, if a company has a couple of different types of products, services they provide, they may want to have more than one revenue account. Okay, and that's okay. This one wasn't rental revenue. It was what? Fees revenue. Okay, and how much was it? 15.5. Okay, record the entry and let's go up. I'm going to see two new ledger accounts, right? I mean, not in two new, one new ledger account, which is going to be now my fees. My cash went up. Machine posted it for me. How about my income statement? Do I have anything on my income statement?
Yeah,
Yes.
the revenue.
Good. There's the revenue, no expenses yet. So my revenue is equal to my net income. Statement of retained earnings is now showing my net income, isn't it? Beginning balance plus net income. And I haven't entered any dividends yet. So my ending balance is just that revenue. Now this is a little bit confusing, guys. Not confusing, but we got to be a little careful. The balance sheet, because they want it to balance, they just automatically plug that ending balance into retained earnings. But be careful to really get a balance in retained earnings. You would, and if you were using general ledger software, you'd have to ultimately go through the closing, wouldn't you, to get amounts into retained earnings. They just kind of stuck it in there so the balance sheet will balance. They kind of did what we were doing, where we were drawing the line down from the statement of retained earnings over to the balance sheet. They did it that way. General ledger software is going to do it that way. General ledger software is going to say, if you want an account balance to have an amount in there, you better go ahead and make some journal entries into it. Okay, and we didn't do that yet, but and this question doesn't even contemplate closing entries. Okay. All right, I want to do one more and then we're going to stop this nonsense. Okay, so let's go back to the general journal. Let's look at transaction list and let's look for, okay, we paid the rent. Let's look at this January 7th entry. We paid the rent. If you pay cash, does your cash go up or down?
Down, so
Down.
credit.
Good. Cash goes down if you pay cash, so it has to be credited. It's 1225. Good. And if I pay my rent, has my future economic benefit expired?
No.
Well, you may feel that because you feel like you pay your rent in advance, but really you pay your rent at the end of the month. They make you give you the first up front. That's more of a deposit. Okay. Rent isn't really and truly what expensed until the end of the month, right? Okay. So when you pay the rent, that is seen as an expense. If the month hasn't gone by yet when you pay the rent, that's a prepaid rent. Okay. But if the month's already gone by when you're paying that, that's a rent expense. So that's what, 1,225? Okay. Okay, good. Record entry. Huh? Oh, go to hell. I don't have to. What's it mad about? Because I didn't enter my debits. That's nonsense. I don't have to enter the debits before the credits. Who said? So they want me to do the rent expense first. Amateurs. What was it? 1125. Doesn't matter. You just have to put them in the right column. You have to debit and credit the right account, but I can put them in to the software any way I want. And then I was supposed to what? Credit cash? 1225. Or how much? Let me see something. It's 1125. What happens if I put 1225? Or 225? Should it take that entry? Should the system take that entry?
No.
I think your entry for
We
the
shouldn't.
rent already went through. I think it was number 7, and now it's on number 8.
I see. It was giving me a hint. Okay.
Oh, it's a note.
Yeah,
Okay.
like along the top it says number 7. I think that was the rent, and now this is a new one.
Because I put my cash first. Oh, okay. This is just a hint. Whatever. You don't have to enter debits before credits. If you think of the credit first, write that down, and then you can do the other thing. Okay. Did I enter it? Did I record entry?
I think so.
Okay. Now I hope I didn't record that twice. Okay. Anyway, this is losing steam here. My income statement now is going to show what? Show the expense. So now my net income is what? 14,275. So now when I look at my statement of retained earnings, the net income is 14,275. And it also shows that on the balance sheet. Okay, I think you're getting the point. I think we're kind of going past the point of we're dealing with loss of returns here, declining returns. Okay, question.
John, I have a question.
Uh-huh.
Back to the office supplies question. Why would we count it as supplies expense?
Why wouldn't we count it as supplies expense?
Right, I'm a little bit mixed up because when I saw the question was like, we got office supplies with cash. So automatically I thought, okay, we use cash to purchase the supplies.
Because that's not accrual accounting. Accrual accounting says you don't take the expense until the future economic benefit has expired. And there was nothing here that indicated to me that future economic benefit had expired. Now, if it said I counted the supplies later and there was only $250 worth of supplies left, then I would debit supply expense and credit the supply account, right? Because that would mean that 1,000 had expired.
Ah, okay.
We don't take an expense because we pay cash. We take an expense because future economic benefit is expired, right? In the case of the supplies in example year 1, year 2, when we got the supplies in year 2, we debited supplies, we credited account payable 24,000. We never paid any cash on those, yet we took the expense when we counted the supplies and there was only whatever it was, 11,000 left, 13,000 left. We took supplies expense of 11,000, right?
Correct.
Okay, so it's not whether you paid it or not that determines whether you paid cash for it that determines the expense. It's what got used, right? So in year 2, we bought supplies for 24,000. We credited accounts payable. We never did pay anything on that. No cash went out at all for those supplies. Yet at the end of the year, when we counted the supplies and there was only 13,000 left, we debited the supply expense, didn't we?
Yes, we did.
Yeah. In the case of this thing over here, there's nothing that indicated that they had used any of those supplies yet. So I debited the asset.
Okay, so in this case, basically, we just recognize it as used cash to purchase, and then we got an equipment that's called office.
Huh? Say that again?
So basically, in this case, we recognize it as we spent 1,250 cash, and then we got office supplies as asset.
Correct. I mean, the point is you got office supplies with future economic benefit. You can either, there's 3 ways to get supplies. You can steal them. Let's forget that. You could buy them for cash or you could buy them for credit, right? On credit.
Correct.
Okay. In the example that we were doing, the in-class example, we got them for credit, right? But that doesn't change the future economic benefit associated with those supplies. So we debit supplies. This case, we acquired them for cash. Okay, so we credit cash because our cash is going down, but the nature of the future economic benefit of supplies hasn't changed just because we paid cash for it, right? So we still debit the supply account.
Okay, understood. Thank you.
Did I hear another question come in? Okay, I'm getting tired. How about you guys? So let's do this. I am going to start with question 3 on the homework. And I'm going to do a few of these questions. And then I'm going to ask you to spend some time going through these prior to our next class. We'll go through every single one of the questions in the practice midterm together. Okay, so don't worry. But I want you to spend some time going through all of these. I'm going to get you started. I want you to spend some time going through all of these, you know, on your own. And then we'll start next class going through these together. Sound like a deal? And then we'll jump into chapter 3. Yeah? Okay. All right, good. But let's go ahead and let's take a look at a couple of these, okay? Now, the best way to answer these questions that really are contemplating, do you know what journal entry would be made and do you know how it affects the account? The best way for you to do this is to just sit here and use your training now of debits and credits, make the journal entry associated with the transaction, and then understand how it affects the account. Let me show you. So company received a cash advance of 700. If you received cash, should your cash go up?
Yes.
When you receive cash, your cash goes up. So should I debit cash or credit cash?
Debit.
Debit.
Good. I'm going to debit cash 700. If someone gives you money in advance, have you earned it yet?
No, so it's a liability.
Beautiful. You haven't earned that yet if someone gives you the money in advance, right? Like if your parents said, I'll give you in advance, but I expect you to pay me back, whatever, right? Okay, so that's unearned revenue. That's unearned revenue of 700.
Yes.
Okay. All right. So let me ask you, as a result of this transaction, did assets increase?
Yes.
Yes.
Cash is an asset. My assets increase. Good. Right. And you know that's the answer because I highlighted it. This is how your exam's going to be without the highlighted answers. Okay.
Is a question, sorry to interrupt, is question C a trick answer, is a trick answer then? Kind of? Liabilities decreased by 700?
Well, I guess it's trick. There's one right answer and 3 wrong answers. And if you want to call the wrong answers trick answers, then I guess they are.
Well, yeah, sorry. That's true. My bad.
Because liabilities didn't decrease, it increased, didn't it?
Yeah.
Credited it. Okay, so that's wrong. Stockholders' equity wasn't affected. Now, maybe you might want to say D is a trick. It's wrong. Assets and stockholders' equity increase. No. Assets, yes. But stockholders' equity, what? No. So the answer is wrong because it's not true that assets and stockholders' equity increase. Only what? Only one right answer on these exams. I don't use all of the above. I don't use none of the above on my questions. Okay. In my exam, there's one right answer. I don't like all of the above. I don't like none of the aboves. Okay. And so the answer here is what? Assets increased by 700. Question? Okay, good. Let's try number 4 here. Sebastian Bella performed $2,000 of CPA services for a client, but has not billed the client at the end of the year. What is the adjusting entry? Again, adjusting entry means what? I got to the end of the year and I had done some things, but I hadn't quite caught up my accounting yet, right? So I'm going to adjust it. I'm going to fix it. I'm going to get it caught up. So if she performed the service, does she need to do anything with her revenue account? Perform the service. Perform the service.
Yes, to credit.
Good. We have to credit revenue. How much? 2,000? That's 2,000. Right? Is that the credit?
Yes.
Okay. Now, she's going to bill the customer, so that means the customer is going to have to send her some money, right? But they haven't sent her any money yet, so she has to debit what? She can't debit cash yet. She has to debit, in this class, AR will always be accounts receivable for 2,000. What is
Makes
that?
sense.
Huh? Something wrong?
No, sounds good. Makes sense.
Okay, good. She's got an asset, money coming in. The fact that she performed the service, the fact that she hasn't been paid yet is irrelevant. She has to what? Adjust her account so now she knows, she prepares her financial statements by the end of the year. Yeah, I've got this 2,000 coming and I've got a revenue because I've performed this service, right? At 2,000. Okay, good. Now, she subsequently, after she does this, receives payment from the client. If you receive payment, should you debit cash?
Yes.
Yeah, let's say she gets, I'm just making this number up, 1,500. What should she credit?
Revenue.
She already took the revenue. She took the revenue when she performed the service. The collection of cash does not necessarily generate a revenue. What generates the revenue is what? The performing of the service. She already performed the service, and now she subsequently, after performing the service, later on receives payment. She already billed the client, so now what should she credit?
Accounts receivable.
Accounts receivable, because now she's getting paid, isn't she? Good. What's the balance in the accounts receivable account? I did what? I debited it for 2, didn't I? Did I debit it for 2?
Yes.
And I credited it for what? 1,500. That means that the balance here is what?
500.
500. Okay. Now they call these T accounts. Do you see the T? Do you see the T?
Yep.
I pity the fool that doesn't see the T. Do you see the T?
Yes.
Okay. It's like a what? It's like a scale like this, isn't it? Hey, I'm a little debit heavy. So this account has a debit balance of 500, which is what she still owed. You see the T? Okay. I say that because I had a student one night said, I don't see the T. I don't see a T. Okay. Okay, good. Question. This looks like some sort of religious icon of some sort. You know, they said 12th century Venice were very religious people. So they've got revenue. They've got T accounts that look like religious things. Okay. All right. So I want you to say your prayers tonight. Say, please let me understand debits and credits, right? And they will help you. Pray to Padre Pacioli, and you're going to be in good shape. All right. Okay, guys, I'm going to get us done here a little early tonight. Please don't get too upset with me for doing that. I want to give you a little time to look through, you know, the balance of this, what do you call it, practice midterm. I will be putting up the URL for this class for you into, I'll put an announcement up into Canvas so you can go in and mess around with some of those connect questions. Once you do that, you don't have to give them any money up front. Once you go ahead and you do that, do the 2-week trial period, and that'll give you some time to mess around with that. If you think it's useful to you, beneficial to you, go ahead and buy the book then when they ask you for money. If you feel you've had enough, I am not going to require you to purchase the book and the software. You can if you want to, but you don't have to. Question?
When it comes to this exam, I looked it over and I saw that a lot of the business names go there after bands, and I was wondering if that's your music selection.
That's not my music selection. You're right. They are bands like Sebastian Bell, the Meat Puppets, and some of those.
Yeah.
No, this is kind of like, I want to say this is middle 90s bands, and not middle 90s bands that I followed. You know, if there was a band from the 90s that I got into, I'm more of a Metallica guy. So yeah, so I didn't follow a lot of these. These come from the textbook. Some of them I wrote. Froggy Company. If you see Froggy or Busters, I wrote it. If you see some of these Mud Honeys and Fugazi, that's not me. I'm about as limited. I'm limited to Froggy. If it's Froggy, Busters, or Kitty, I wrote it. Okay.
Questions for number 10 and 11. I saw the highlights are green, but the overall question is just, so the answer is for A for number 10 and A for number 11. So both of them are A. The
Yeah,
yellow-
that I should delete these questions. We're not going to have any depreciation questions.
All right, thank
You
you.
should not be able to answer this, and you will not have to answer it until after chapter 8. But yeah, that green is the right answer. This reminds me of my artwork when I was a kid. One time I took a red crayon and drew something like this on the stucco, the white stucco in front of my house. And so the whole family stood there stunned, and my dad wasn't home from work yet. So my older brother, he's 9 years older than me, got a white bucket of paint and painted over it. And then we all sat there holding our breath when my dad came home, and he walked right by it and didn't notice anything. I suspect my mom probably was laughing, telling about the next day or that night or whatever, because I was too young to get in trouble for it. But I do remember doing that. Anyway, more information than you needed. Any other questions? Yeah, no depreciation questions. So that means also, yeah, that's the only one I think we got to get rid of. Yeah, those two we won't do. Okay, we won't have to worry about. Question? Yeah, sometimes when I highlight, it won't unhighlight, and it makes me highlight everything, and so I just change the color. Okay, guys, have a good night. Don't stay up too late. Try to get some rest, and we'll see you on next Tuesday. And in the meantime, I got to get you that URL so you can start messing around with that stuff in Connect. Don't give them any money till after you've tried it.
Okay. All right. Good night.
Okay, guys.
Good
Good night.
Thank you, John.
Bye.
Thank you.